This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
My name is Brandon Cook. All these markets that Jason and his network endorses are great markets. We're getting better, higher rents. Prices are going up right now, but with financing terms as good as they are, there's still real great deals, and all have been through Jason's network.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Bonjour and greetings from Cannes, France, the place where they have the big film festival. I was here about 4 or 5 years ago for just that exact film festival, and offshore here in our stateroom, coming to you for this episode. I would love to show you the gorgeous view of the harbor with all the yachts and so forth, but moving the computer around and upsetting the thing is a little difficult. So I won't do that right now, but get those pictures for you later. Anyway, we have got a good show for you today. We are going to talk about another big investment principle with our guest, my friend Manny, who is a hedge fund manager. I invited him back to do a short clip, about 7 minutes or so, just on another key financial principle, but applying it to income property, the most historically proven asset class in the entire world, as you know. All right, we've got some good data out here from MarketWatch, and I want to share that with you. If you are watching this on video, you see what's on the screen here. This is a map of the United States, and the caption is, a majority of counties in the United States are experiencing total real estate listings below 2017 levels based on data from Realtor.com. And what you see here is just this ongoing shortage of properties that may last for up to 28 years. Yes, 28 years. Because that's how long these people have on their mortgage. Here on the cruise, yesterday I was by the pool talking to a guy who was talking about his properties, and his brother was with him, and his brother was talking about his properties and all their real estate investing stuff. And he started talking about his own house and how he was thinking of moving. He and his wife wanted to make a move. And I said, "You're not going to move, are you?" And I said, "I bet you are finding it very difficult to justify a move, though you can afford a move, because I'm guessing you have a very cheap mortgage." And he says, "Yeah, 2.6%. He has a 2.6% mortgage in unduplicatable, incredibly discounted, lowest interest rates in 5,000 years type of mortgage. Again, read that great book by the late David Graeber, Debt, the First 5,000 Years, and you really realize how insanely low these interest rates are and how people will just not be parting with these mortgages anytime soon. And this is causing the listing shortage. As I mentioned on the last episode when I was in Portofino, the things that could break this lock on the property market that is just going to make the market savagely worse for buyers, but better for owners, are a couple things they could do, right? They could make mortgages portable. I mean, what if you could somehow figure out a way to move the mortgage to the next house, right? Now, that is so hard to do. Let's assume that the lenders and the government actually wanted to do it. which huge assumption, right? Very, very unlikely. But even if they wanted to do it, the mortgage amount wouldn't be high enough, right? Because if someone has a $300,000 mortgage on their existing home and they want to move to a $600,000 home, maybe their home is worth $450,000, their mortgage balance is $300,000, and they want to move to a $600,000 house. Well, now they want a mortgage for $450,000, $500,000, $520,000, right? Whatever they can get, the highest amount they can get probably. But even though if they could move that mortgage, there's still not a high enough balance on that mortgage to make the new house work. So that's one radical idea that they could try. I mean, I remember hearing someone talking about that on a TV news station many, many years ago. And I thought, well, that's an interesting idea, but just the hurdles are massive. You just couldn't do it, right? Even if everybody wanted to do it, it would just be too difficult. Okay, so the other thing you could do is eliminate the due on sale clause. And that would allow sellers to sell their properties and buyers to assume those low rate mortgages. But nobody's going to want to do that. I mean, why would any lender, bondholder, et cetera, if you have a security that you own attached to a mortgage pool, for example, right? Remember, Louis Ranieri in the early 80s was the guy that pioneered securitized mortgages that massively expanded the mortgage market, and by virtue of doing that, massively pumped up the values of U.S. real estate, because you created this whole market for mortgage assets by investors. Well, nobody's going to want to do that deal, right? Because if you have, say, a bond attached to a mortgage rate, and now you're in a higher interest rate environment, that bond value has declined significantly. So you want to be paid off. You want to cash out. You want that loan paid off, right? Because you want to be able to reinvest your money at a much better yield. So that's not going to happen, right? Nobody's going to agree to that deal. So it looks like this lock on the property market is going to be persistent, and it's going to be very, very ugly and challenging for buyers and renters. But it's going to be great for you as an investor, because the supply will continue to be very much limited and constrained for quite literally decades to come. Well, I guess the other thing that could happen, of course, is we could enter another massively low interest rate environment. Unlikely for sure, but say that happens. Okay, if it does happen, then you're going to see prices just climb massively. Now, I do think, obviously, rates will go down. I have a terrible track record at predicting interest rates, for full disclosure, so don't rely on me. But my personal opinion is we are going to see a pivot, and we're going to see mortgage rates settle around, 5.5% maybe, right? Ultimately, when it will happen, I do not know. Nobody knows. Very tough to predict interest rates again. But that is still not going to help, because basically those mortgage rates will be double the amount of the existing mortgage rates, the majority of them out there in the existing home market. Okay, what's the other disruptive thing that could happen? Well, a disruptive technology that allows for a massively increased supply of new home construction. And again, it's a low-tech asset class. This is not going to be 3D printing. We've done the shows on that. We've done the research on that. 3D printed homes are not going to be the big disruption, okay? It's just very hard to disrupt anything that is based on atoms. There's lots of disruptive technologies based on bits, right? Software. Anything that's virtual, very easily disrupted and demonetized. But anything based on atoms that's real, that's material, very, very difficult to disrupt. So all of these things bode very, very well for your future as a real estate investor. So congratulations, right? Congratulations. Very hard to disrupt the asset you own. And hopefully you're going to own a lot more of those assets, and that's going to create a better and better future for you. Anyway, that map is very telling when you see visually how there is this incredibly short supply of real estate. And look at some of these areas on this map. If you're watching this on video, if you're not, I'm just basically explaining it to you. The change in listings since April of 2000, hardly any areas are up in terms of increased supply of listings. The vast majority of the country, down, 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 much less supply, 2017, much less, a huge, huge problem. And it leads to another problem, right? Reduced sales volume. And so this article from Housing Wire says existing home sales fell by 23% in April. Fewer homes on the market mean fewer transactions are taking place. And here we see the article, this National Association of Realtors data, NAR, after posting a surprise 14.5% monthly increase in February, existing home sales were back down again in March, a trend that continued into April, with existing sales posting a 3.4% monthly decline to a seasonally adjusted rate of 4.28 million. On a year-over-year basis, sales were down 23.3%. Quote, home sales are bouncing back and forth, but remain above recent cyclical lows, unquote, Lawrence Yun, NAR's chief economist, said in a statement. Quote, the combination of job gains and limited inventory and fluctuating mortgage rates over the last several months have created an environment of push-pull housing demand, unquote. And of course, Lawrence Yun has been on the show a few times over the years. You've probably heard those interviews. If you ever want to look at some of our old interviews, of course, you can search them on the YouTube channel. You can go to jasonhartman.com and use the search engine there to do really micro searches and find very specific things on old episodes if you want to look up any of those old episodes. So Zillow, here in another quote, it says, quote, well, it's true that there are fewer buyers who can afford to compete in today's housing market. A key piece of the story is that there are fewer homes for those buyers to shop for, unquote. Nicole Bouchard, the senior economist at Zillow, said in a statement, quote, the severe lack of new inventory coming onto the market is restricting home sales more than the pullback in demand. So again, demand is lower, yes, because affordability is lower, but the inventory is even lower than the demand. So again, for all of the crash bros out there waiting and waiting for the big crash, it just isn't happening. And there is almost nothing that is going to make it happen. Again, there are black swans and things can happen, but you just look at this data that we've gone over and over again. Look at what Yoon says here in the article. Roughly half of the country is experiencing price gains, even in months with lower prices, primarily the expensive West Coast region. Again, cyclical market, not a linear market, not a hybrid market. Multiple offer situations have returned in the spring buying season following the calmer winter market, right? So despite the volatility and uncertainty in the economy, distressed sales represented just 1% of all sales in April, the same as March and a year prior. So again, if you want to have a housing crash, you've got to have distressed sellers. And we just simply don't have that in any real way. So here we go. Here's another article. Top metros with the most foreclosure starts in Q1 of this year. According to Beta's Q1 2023 U.S. foreclosure report, there were 95,712 U.S. properties with foreclosure filings during Q1, up 6% from the fourth quarter of the prior year, right? So up a little bit, and up 22% from 1 year ago. But again, a year ago, there was like nothing. Okay, nothing. This is a giant country with 332 million people. So again, there's like no foreclosure activity. If you were in one of the businesses related to real estate foreclosures right now, and for the last few years, you would be just absolutely starving. I mean, these companies can't really make much money without a lot more foreclosure activity. So here's the chart. If you're looking at this on video again, you can see that foreclosure activity is almost nil. And most of these foreclosure filings, again, when we had Rick Sharga on, we took a deep dive onto this just a couple of weeks ago. Most of these properties with process, first comes notice of default, And then it is a long process. And then there is finally a foreclosure sale. But most of them don't get there. Maybe they've got an NOD filed against them, the notice of default, but they never make it to the foreclosure sale. So the number of foreclosures actually happening is dramatically lower than the number with foreclosure filing. Make sure you understand that distinction. All right, let's talk for a moment here before we get to our guest about suburbia. I predicted in late February of 2020, as the COVID pandemic was starting, right? I predicted this mass movement to suburbia. And I talked a lot about back then, go listen to the old shows. You can just hear those recordings or watch the videos. I talked about how America is a very unique market because of its suburban lifestyle. And here, look, I've been in Europe for a little over a month now. This is one of my longest European trips. Of course, I've been here many, many times before. And it is just so interesting to see how the concept of suburbia is so uniquely American. Yes, they have suburbs in other parts of the world. Of course, I've been to 91 countries now. There are suburbs, but just a very small amount of suburban development versus the United States. The post-World War II baby boomers, Levittown, all of this suburban sprawl was built back then. America's love affair with the automobile. And by the way, it's not all good. I'm not saying this is good. I'm just saying it is the way it is, right? In a lot of ways, these older European cities actually offer better lifestyles, in some ways, not always, and maybe better planning, oddly, because they're not built around the automobile so much. But look, it is what it is. We could debate that until the cows come home, right? But the U.S. is a very suburban market. And for the last 18 years, I've been helping people invest in these suburban markets, and they have done extremely well. So we're now seeing the retail apocalypse for many years. This article is entitled America's Surprise Revival, the Suburbs. The big picture, a number of demographic, housing, and business trends are coming together to revive the suburbs. Well, I don't think that the suburbs really had any problem at all before this. I mean, I've lived in suburban markets most of my life, and I've always seen them booming, but I guess they're reviving even more. By the numbers, between 2010 and 2020, the share of Americans living in the suburbs grew by 10.5%, according to census data. And the pandemic only accelerated this trend, according to the New York Times. This is happening as an increasing share of millennials. So many people are talking about how millennials are moving to the city. Really? I don't know. Apparently not. An increasing share of millennials, the largest generation, are buying homes and settling down. They are choosing to do so outside of cities. We've always talked about millennials as urban people living in apartments, using Uber, going out for brunch. Hey, remember the avocado toast thing? I'd rather have avocado toast than buy a house, right? Professor, I can't pronounce his name, Professor Lee, professor of housing and property management at Virginia Tech. But as it turns out, they're not cool anymore. So that city living, not cool anymore, right? Some 45% of millennials expect to buy a home in the suburbs, according to a recent Bank of America survey reported by Fortune. Another major trend, driving people to the suburbs, is the new era of hybrid and remote work. Anyway, I don't need to go into the whole remote work thing. I mean, we've talked about that ad nauseum on the show. A lot of these trends just aren't what people think they are. And the article goes on to say a number of big name chefs are choosing suburban towns instead of major cities for their next restaurant, per the New York Times. These changes are also shifting the demographic makeup of the suburbs, which has long been thought of as whiter and less diverse than cities, okay? And it is shifting that, right? Big suburbs are now more racially diverse than the country as a whole, according to Brookings Institution. And the reality check is don't count out the downtowns yet. And Lawrence Yun is saying this. Even with hybrid work, people are returning to downtowns. And while the suburbs are relatively close to cities and thriving, housing demand in the faraway burbs dropped significantly from the pandemic's peak, he notes. So again, a little bit of an offset there in that statement, but certainly not completely. Huge interest in the suburbs. Okay, so let's get to our guest for today's episode and learn another principle of high finance that hedge fund managers use as it applies to income property. Let's welcome Manny Kim back to the show, and today he is going to teach us about VaR, otherwise known as value at risk, what it means to you as an investor, especially as a real estate or income property investor. So let's take a dive into this topic. Manny, welcome back.
Thank you, Jason. Thank you so much for having me again.
What is VaR?
Well, VaR stands for value at risk, and it is it's actually used a lot in investment banks, believe it or not, because they manage such a huge, trillions and trillions of dollars worth of assets. So they need a relatively easy to calculate statistical measure that tells them at any given point in time, they trade actively, right? Any given point in time, what the firm's daily, weekly, quarterly, even probably yearly risk level is for those time periods, right? And they want to calculate also what's the probability that a certain amount of risk will happen, right, given that time frame. So they want to be very precise in how they measure this. So VaR is basically a statistically derived measure to describe the loss risk for any given portfolio, asset, or a group of assets in a certain time frame at a certain level of odds, so like 1 in 20, 1 in 10, or 10%, or 5% probability, which is commonly used. And it actually gives you the number that you're likely to lose. Very precise. So it's very commonly used in investment banks, actually, and trading firms. So there are actually 3 ways to measure this. We can do a little bit of a longer discussion related to other things in terms of what that implies for both the investors in general and specifically real estate investors. But there are 3 ways to measure this. One is you use the actual historical data that you have on the portfolio or the asset. That's the most granular way of measuring it. The second way is what's called the parametric method, meaning, let's say you calculate the average and the standard deviation, just like we did for the Sharpe ratio, right? For the returns of the asset. Then you assume a certain like a bell curve or a certain type of a distribution. Okay. So you can use different distributional models, like a normal distribution. You can use a student T distribution. There are different statistical distributions with a certain curve that you can use that you can assume. And then you calculate how much you're going to lose at a certain time period for a certain risk level. Right. And the third method is what's called the Monte Carlo method. So this is basically using random numbers and a bunch of computer simulations to understand how the asset is going to perform, right, based on sample data. So you're not looking at the whole data, you're looking at sample data. So today I'm going to use just a historical data version because the parametric method involves a lot more mathematics and that'll take a little bit more time. So I want to give an example with the historical data. So just to illustrate what those 3 methodologies are, 2 of them are presented here. So this is a distribution of the daily returns of the NASDAQ, I think for 4.5 years or so. So this is every day. Like if you put money into the NASDAQ, right, today, what return can you expect tomorrow? That's the daily return, okay? Now, when you turn this into what's called a histogram, so a frequency diagram into like a bell curve, this is what the actual data looks like in bars. So the blue and the gold bars is what the actual data is. Now, that's the historical method that we're going to use, right? Now, what statisticians do is that they take a couple parameters like the average, standard deviation, skewness, and kurtosis. Those are technical things that you can derive from that data set. And then they overlay the line with the dots in it, which is a model on top of the data, okay? That's usually used by very sophisticated firms because sometimes the real data, either there's not enough of it, or sometimes the real-time data is not indicative of future returns, right, that you had in the past, just like you mentioned before. So VAR in this chart basically is looking at where the yellow bar starts, okay? So let's say that, so there are blue bars and the yellow bars in this diagram. The VAR is looking at the number at the bottom on the x-axis where the yellow bars start. And where you make the yellow bars start is depending on what kind of odds you want to calculate, right? So do you want to know the 1 in 20 odds, the 1 in 10 odds that you're going to lose money, right? So you choose that risk level, right? So for our calculations for the stock market and the real estate, we're going to use 10 and 5% probability. So that's like 1 in 10 odds and 1 in 20 odds. We're going to use just the raw data itself, the historical method, and we're just going to look at percentage loss, right? We're not going to look at the actual amount, which is what VAR usually calculates. So notice in this chart, we're basically doing the same thing here, right, with the stock market. So we're putting it into a histogram, right, to kind of give that bell curve shape to the data. So now when you calculate the actual value at risk on a quarterly basis, at 10% chance, the stock market will, on average, will lose 6.2%. So in any given quarter, right, there's a 1 in 10 chance that you'll lose 6.2%. Now, if you look at 5% chance, you will lose 8.5%. Okay. So that's basically what VAR is calculating. And you can choose what the odds are going to be. So, I want to know what the 20% chance is, in any given quarter, or 25. So usually 10 and 5. So 10% chance and 5% chance is the standard number that's used to calculate VAR.
I'm just wondering how you know. Yeah, I'm just puzzled about how you know what your chance to lose is.
Yeah, so you're assuming with VAR that whatever historical data you have, which is the method that we're using, is going to be stable into the future, because we're using 52 years worth of data, right? And so every quarter we measure the return and we use that as a model to predict into the future, right? Because this is looking at a statistical distribution of how frequently a certain level of return happens or a certain loss happens, right? So you're using that to basically create odds out of that. Does that explain it?
Yeah. Okay.
Yeah. So in terms of income property, the value at risk is significantly lower. So at the same level of odds, right? If you look at what's the 10% chance that I'll lose money? Well, at that given level of odds, you're only going to lose less than 2%, like 1.94% for income property, right? And at 5% level, it's 3.74%. So look at the difference between just the VAR difference for the same parameters, how much risk you're putting into the market in any given quarter, right? So for income property, it's less than 2% at 10%, but for the stock market, it's over 6%. For the 5% chance that you lose money for income property is 3.7. For the stock market, it's 8.5. So overall, the stock market is much more risky at given levels of odds, right? Any given quarter. So I wanted to also put this into a comparison chart. So visually, you can see this too. So this is basically plotting the quarterly returns on a histogram, which means you basically look at each segment of returns, starting from probably negative 30 all the way to positive 25% on a quarterly basis, right? And the x-axis is the frequency as to how many times that happens, right? And every quarter. So obviously, most of the time, the stock market or the real estate market is not going to move that much, right? Maybe 1% or 2% each quarter, or 3% each quarter. So that's why it's the fattest in the middle, right? Just like a normal distribution, most people are
just
average,
like any bell curve,
right? Yeah, like a bell curve. So that's all we're measuring here with this histogram, right? But notice that the blue bars, which looks at homes, right? Just a median income property in the United States, that distribution is extremely stable. Look how centralized the distribution is, right?
Right.
Versus the stock market is extremely wide. I mean, you have some quarters where you make over 20%, and you have couple quarters where you lose like 20% of your money, but that doesn't happen in income property.
Right.
So what the VAR is basically showing in a different way through numbers, right, that's very precise, is what you're seeing on this chart visually, right, is that in any given quarter, right, you have a higher chance that you'll lose money by a larger amount with the stock market than with income property.
This doesn't come as a surprise to any real estate investors.
Sure. Yeah. But I think the key is that you can actually measure how much you'll lose.
Right.
That's the key, right? You're putting it into numbers what we experience, right? Or what you guys experience as real estate investors. So let's say that you want to know, like, well, if I invest into real estate, right? And this is the next topic, but let's say, what happens if there's another 2008 or another financial crisis? Like, what is the number that I'm going to lose in terms of the price of the property that I own, right? You can precisely measure that. Right. That's the difference, right? And even though, let's say, the actual number doesn't turn out to be precisely like let's say for real estate, like 1.94%, you'll know on average, like, okay, like real estate at the same level of odds of losing money is going to be more than half less volatile or more than half as risky as stocks, right? That's really what VAR gets at. It's like the relative risk levels, right? By using numbers.
Very interesting. Well, Manny, thanks for explaining this to us and the Sharpe ratio on a prior episode as well. Give out your website.
EZCapital.com.
Excellent. Manny, thanks for joining us.
Thank you, Jason, for having me.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.